When you look at a modern car, especially one of those sleek new SUVs rolling off the lot, it is incredibly easy to get distracted by the surface.
Oh, totally. You slide into the driver's seat and you're just looking at the screens, right?
Exactly. You see this ultra-responsive touchscreen interface dominating the dashboard or, the intricate leather stitching on the steering wheel.
Yeah, or the aggressive styling of the front grille when you first walk up to it with your smart key.
Right. You turn it on, put your foot down, and you just kind of assume that underneath all that sheet metal, the engine simply creates power and the wheels magically turn.
Which is, a wild oversimplification of what's actually happening down there.
Yeah, because if you were to actually peel back that exterior, if you could somehow X-ray the vehicle while it was climbing a muddy hill or accelerating onto a wet highway, you wouldn't just find an engine spinning in isolation.
No, you would uncover this incredibly complex, hidden nervous system and muscle structure.
A literal labyrinth of precisely machined metal, gears, and electronic actuators dictating exactly how, when, and where the vehicle's power actually gets transferred to the road.
It is a phenomenal amount of hidden mechanical choreography taking place in milliseconds. Because, an internal combustion engine by itself just generates rotational force. It just spins.
Right, and if you connect that spinning block of explosions directly to a wheel, the car would either stall instantly or rip its own tires apart.
Exactly. You need intermediaries. You need a system that can take that raw, violent energy, tame it, multiply it, and distribute it dynamically.
Especially depending on whether you are cruising at 80 kilometers an hour or, stuck in a ditch with one wheel suspended in thin air.
Yeah, without that hidden architecture, all the horsepower in the world is completely useless. You aren't going anywhere.
Okay, let's unpack this. Because today, for you listening, we are taking a deep dive into the very specific, highly technical world of the company that actually builds those hidden muscles.
We are looking at a stack of incredibly detailed research, financial models, and industry commentary on a deeply entrenched player in the Indian automotive sector.
Right, Divgi TorqTransfer Systems Ltd, or DVGTCs for short.
And whether you are an industry professional embedded in auto manufacturing, a market observer, or just someone fascinated by how complex machines actually function, this is going to be a masterclass.
We are opening up the hidden mechanics of India's ongoing SUV boom and the incredibly high-stakes transition to electric vehicles.
To really ground our understanding of where they sit in the automotive universe, we are looking at a pure B2B drivetrain supplier here.
So they operate in a highly specialized, mechanically necessary, and crucially partly under-localized slice of India's auto component stack.
Right. They are not building the entire car. You won't see their logo on the steering wheel, and they aren't selling anything directly to you and me.
Yeah, they are selling directly to the automotive giants, the OEMs.
Exactly. But when we throw around a term like drivetrain supplier, it can sound a bit abstract.
It really can. So what physical metal is actually rolling off Divgi's production lines in Pune? Like if I walk onto their factory floor, what am I looking at?
You are going to see a highly technical product lineup that breaks down into a few distinct categories of heavy engineering. First, you have their absolute flagship products, which are transfer cases.
And these come in a few different flavors.
Yeah, they manufacture mechanical shift transfer cases, electronic shift on the fly variants, and the highly advanced torque on demand transfer cases.
Wow, okay. And then branching out from there.
Then you have torque couplers, specifically their interactive torque coupler product family.
Right, and next you move into the transmission side with manual transmission synchronizers.
Exactly, and they do both traditional steel-based ones and the much more advanced carbon line synchronizers.
And finally, they make the underlying components that make up these systems, like transmission gears, precision shafts, and their newer dedicated EV transmission systems.
That's the core lineup. And the customer list for these parts reads like a who's who of mobility.
Oh, for sure. We are talking about direct supply lines to automotive OEMs like Toyota, Mahindra, and Tata Motors.
Along with several global Tier 1 suppliers, these parts are getting bolted into passenger vehicles, rugged SUVs, commercial transport vehicles, and even heavy-duty farm equipment.
But reading through the analyst reports, there is a very sharp dividing line drawn through their portfolio. The analysts constantly separate what they call mission-critical systems from more commoditized components.
And that distinction is the entire key to understanding their business model.
How so?
Well, a commoditized component is something like a generic gear, a basic steel shaft, or a simple clutch body ring.
Those pieces are important to the car, certainly.
They are, but an automaker can generally source those from dozens, if not hundreds, of different precision machine shops globally. It is a race to the bottom on price.
Got it. Whereas a mission-critical system, like a complete torque on-demand transfer case or a fully integrated synchronizer subsystem, is an entirely different beast.
Exactly. Because at the system level, you aren't just handing the automaker a hunk of milled steel. You are handing them the brain and the brawn of the vehicle's capability.
Right. System-level solutions require incredibly heavy engineering, deep software and controls capability, and tight platform integration.
Let's take a torque on-demand transfer case as an example. That isn't a dumb piece of metal. It has to communicate with the vehicle's anti-lock braking system.
And the wheel speed sensors and the engine control unit.
Exactly. It has to decide in a fraction of a second to send 30% more power to the front left wheel because it senses a patch of ice.
Engineering that logic, physically building the actuators that execute it reliably over 100,000 miles of driving, and integrating it seamlessly into a brand new vehicle architecture makes it highly strategic.
Right. Once an automaker relies on you for that level of cognitive and mechanical integration, you become incredibly hard to replace.
Wait, hold on. I need to back up to something you mentioned in their product lineup because it really threw me when I was reviewing the notes.
Oh, that was that.
Manual transmission synchronizers. I mean, I completely understand the high-tech transfer cases for modern SUVs, but aren't manual cars going the way of the dinosaur?
It does feel that way sometimes, doesn't it?
It really does. It feels like almost every new vehicle heavily marketed today is an automatic, a dual clutch, or a CVT. Investing in manual transmission tech feels like perfecting the VCR in the age of streaming.
What's fascinating here is how heavily our perception can be skewed by Western market trends.
Okay, fair point.
While the manual transmission might be fading into obscurity in North America or parts of Europe, in India, the manual transmission still absolutely dominates the mass market.
Oh, wow. So the growth engine for Divgi in this segment isn't about riding a wave of some radical new invention.
Not at all. It's about sheer, staggering vehicle volume in a specific geographic reality.
So they are supplying a technologically mature market, but the absolute size of that market in India makes it highly lucrative.
It's the volume, yes, but it is also a structural evolution within that volume. We are seeing a powerful trend of premiumization even within the manual transmission space.
Right, because as Indian consumers move up the vehicle ladder, graduating from a basic entry-level hatchback to a premium compact SUV, their expectations change.
Exactly. They want smoother shifting, reduced vibration, and better overall drivability. If you have ever driven an older, cheaper manual car, you know that crunching, notchy feeling when you force it into second gear?
Oh yeah, where it feels like you are grinding coffee beans in the gearbox. It's awful.
That grinding is exactly what a synchronizer is designed to prevent. A synchronizer uses friction to match the rotational speed of the gear to the transmission shaft before the teeth engage.
And the premiumization trend means OEMs can no longer get away with using basic single-cone steel synchronizers in these higher-end vehicles, right?
Exactly. They need higher cone, multi-piece designs, often using advanced friction materials like the carbon-lined synchronizers Divgi manufactures.
Which is wild. Using advanced carbon materials just to make a physical gear shift feel smooth to the human hand.
Yeah, the carbon lining provides a much smoother, more consistent friction coefficient, making the gear shift feel effortless to the driver.
So this combination of overall market volume, the demand for premium driving experiences, and a heavy push for localized sourcing keeps that manual transmission component demand incredibly durable and profitable for them in India.
Absolutely. So knowing they manufacture these highly engineered, mechanically vital systems, we have to ask how large the actual sandbox they are playing in is.
Right. Their total addressable market, or TAM. And the sources make it clear that you can't just look at total car sales and call it a day.
You absolutely cannot, because this is a content per vehicle market, not a direct-to-consumer market.
Yeah, to truly understand Divgi's addressable opportunity, we have to do a rigorous bottom-up build of 3 specific buckets.
Right. The synchronizer market, the transfer case market, and the differential or torque transfer systems market.
I want to walk through the math concept for the transfer case TAM specifically, because the breakdown in the research notes is fascinating. It proves that their growth isn't directly tied to just, more cars on the road.
Oh, definitely not. How does the math break down?
So to find their addressable market for transfer cases, you take the total production volume of SUVs and utility vehicles in India. Then you multiply that number by the penetration rate.
Meaning the percentage of those SUVs that are actually built with four-wheel drive or all-wheel drive system.
Exactly. And finally, you multiply that resulting number by the specific rupee content value of the transfer case going into each vehicle.
It is highly production-linked and heavily reliant on consumer preference shifts.
It functions almost like a nested Russian doll. It's a niche within a niche.
I love that analogy.
Right. The outermost doll is total SUV production. You open that up, and inside you find the smaller doll representing only the 4WD and AWD vehicles.
And then you open that one, and you find the specific transfer case content value.
Yeah. But the strategic beauty for Divgi is that as the outer doll, the overall cultural shift toward SUVs expands, the inner dolls expand significantly with it.
And that outermost doll is expanding at a remarkable rate. The rising SUV and utility vehicle mix in India is arguably the most important structural driver for their legacy business.
Because Indian car buyers are overwhelmingly shifting preference toward SUVs.
Yes, they want the higher seating position, the perceived safety, the utility, and increasingly the genuine off-road or all-weather capability to handle challenging regional infrastructure.
And that consumer demand directly drives the automakers to increase their 4x4 and AWD offerings, which pushes up the penetration rate.
Exactly. That penetration rate is the direct, unadulterated driver of transfer case demand.
But the research introduces another layer to this market sizing that works heavily in Divgi's favor, right? The crucial difference between the open market and the served market.
Right. Historically, a substantial portion of India's automotive drivetrain market has been import-dependent, particularly when it comes to these high-complexity, precision-engineered parts.
So a domestic automaker might design and assemble the vehicle in India, but they would import the advanced torque-on-demand transfer case from a global supplier based in Europe or Japan.
Exactly. The open market for Divgi represents the portion of that total demand that can realistically be localized.
And government policy is stepping in to act as a serious tailwind here. It isn't just organic market forces at play.
The broader policy environment in India heavily favors domestic manufacturing and aggressive supply chain resilience initiatives.
Which makes sense.
Right.
The government and the automakers themselves are highly motivated to localize their supply chains.
Absolutely. Shipping heavy, complex metal components across oceans is expensive, carbon-intensive, and prone to logistical nightmares.
Yeah, as recent global supply chain shocks have definitely proven, OEMs have persistent, powerful incentives to source these parts locally.
Consequently, Divgi's growth opportunity isn't merely tethered to organic growth in SUV sales.
Right, they have the dual engine of displacing imported systems and capturing a significantly larger share of the existing pie for domestic suppliers.
Which is a huge structural advantage.
But if there is a rapidly growing, highly lucrative pie for localized drivetrain parts, Divgi certainly isn't the only company hungry for a slice.
No, definitely not.
Let's look at the competitive landscape and how they actually defend their turf.
Well, they hold a highly distinct, rather dominant market position within their niche. In the specific realm of Indian passenger vehicle transfer cases, they are the clear leader.
The broker research estimates they hold a 32% to 39% market share as of FY23.
Taking over a third of the market in such a specialized engineering category is a formidable footprint.
And when you look at torque couplers, the research cites them as the only manufacturer currently producing them domestically in India.
But their competitive set is varied. They do face off against domestic players like Avtec and Nazanin for certain components.
But the real threats, the heavyweights, are the global Tier 1 automotive giants. We're talking Aisin, BorgWarner, Dana, and ZF.
Right. Okay, I have to ask the deeply skeptical question here. Go for it.
If global juggernauts like BorgWarner or ZF have infinitely deeper pockets, unparalleled global scale, and R&D budgets that likely dwarf Divgi's entire market capitalization, what is stopping them from just flooding the zone?
It's a fair question.
Why don't they just crush Divgi on price, leverage their global OEM relationships, and take the entire Indian market for themselves?
If we connect this to the bigger picture, you have to look at the structural nature of Divgi's moat. Their competitive advantages are incredibly specific to the realities of auto manufacturing in India.
Okay, like what?
First, they possess a severe localized cost advantage. The commentary surrounding their public listing cited internal calculations suggesting Divgi could price some of their transfer cases 20% to 25% below those global peers.
Wow, because they are manufacturing entirely locally, sourcing their raw steel locally, and completely sidestepping import duties, ocean freight, and international logistics costs.
Exactly. Furthermore, they have immense physical and operational proximity to their customers. They operate manufacturing facilities right inside the major auto clusters, like Pune.
And in modern automotive manufacturing, just-in-time supply is the absolute law of the land, right?
Oh, without a doubt. Being located just down the road from your OEM's assembly plant drastically reduces freight time, cuts down the inventory burden on both sides, and minimizes the risk of a supply disruption halting a billion-dollar assembly line.
But reading through the engineering breakdowns in our sources, the most impenetrable defense seems to be the concept of engineering depth and switching costs.
Yes, the concept of OEM embedding is the ultimate fortress wall in this industry.
How does that actually work in practice?
Let's walk through a hypothetical scenario. Imagine an automaker, let's say Mahindra, decides to qualify Divgi's transfer case for a brand new, highly anticipated SUV platform.
That supplier award does not happen overnight, I assume.
Not at all. It is the culmination of months, sometimes years, of intense engineering collaboration. Divgi's engineers are sitting with the OEM's engineers, tweaking the software controls, modifying the mounting brackets, and tuning the torque delivery.
Right, to match that specific vehicle's weight distribution and engine output. It's not a generic part you pull off a warehouse shelf, bolt onto the chassis, and hope for the best.
Exactly. It is intimately integrated into the DNA of the vehicle, and the validation process is grueling.
Yeah, the part has to be tested in extreme desert heat, sub-zero freezing chambers, and run through millions of cyclical stress tests to ensure it won't fail under load.
Once that platform finally goes into mass production, replacing that supplier cycle is a logistical and financial nightmare for the automaker.
Because to switch from Divgi to a competitor, the OEM would have to start that entire grueling process over again.
They would have to re-engineer the vehicle's drivetrain integration to fit the new part, put the competitor's component through the same exhaustive durability testing, and re-homologate the vehicle with the regulatory authorities.
The switching costs are an enormous, almost insurmountable deterrent.
Unless Divgi severely drops the ball on manufacturing quality, fails to deliver parts on time, or goes bankrupt, they are essentially locked in for the entire multi-year life cycle of that vehicle platform.
So they have this localized cost edge that undercuts global peers. The physical proximity to ensure the assembly lines never stop, and the sheer heavy inertia of automotive engineering acting as a fortress wall around their contracts.
Yep.
So what does this all mean? How does this deep engineering advantage translate into the actual financials? Let's follow the money and look at the financial engine powering Divgi.
Well, their revenue model is fundamentally built on program-based long-term supply contracts. They are not in the retail business.
Right, they don't make money hoping consumers walk into an auto parts store on a Saturday to buy a transfer case.
Exactly. They generate revenue when a new vehicle platform officially launches, and they begin supplying components in high production volumes directly tied to that specific vehicle's daily assembly line output.
And when looking at their margin structure, the reports indicate it is highly sensitive to a few very specific volatile inputs.
Yes. Global steel inflation, the intense cost of precision machining at scale, and overall plant utilization are massive factors.
But what really jumped off the page in the financial reports is their structural health. Their balance sheet is an absolute fortress.
The numbers are genuinely striking, especially for a heavy manufacturing company. They operate effectively as a net cash business.
Just to put the exact figures on it from the latest reports, they are sitting on a cash pile of roughly 280 crores to 295 crores.
And their gross debt, it is a tiny fraction of that. Just 1.08 crores to 1.6 crores.
That is wild. Their debt-to-equity ratio sits near absolute zero at roughly 0.2%.
Which is incredibly rare for a Tier 1 industrial auto ancillary supplier.
Yeah, usually companies operating in this heavy metal space carry significant leverage.
Right. They have to borrow heavily to fund the huge upfront tooling costs, the robotics, and the planned expansions required before a single part is sold.
We should also touch on the specific working capital dynamics of operating in this space. This is, by necessity, an inventory and receivable heavy business.
It is. Because they are the critical link in the OEM supply chain, they are forced to hold substantial raw materials, vast amounts of work in progress on the factory floor, and finished safety stock to ensure they never miss a delivery window.
And because the OEMs hold all the cards in the relationship, they dictate the payment terms, meaning Divgi's receivables can stretch out considerably.
We observed exactly that in the FY24 data. Their receivable and inventory turnover metrics slowed down noticeably.
That is a critical operational metric to monitor, right?
It is. Now, It is fairly typical during a ramp-up phase of new programs. They have to build up significant inventory buffers to support upcoming high-volume launches.
But it inherently means their cash conversion cycle gets stretched. They have to pay for the steel long before the OEM pays them for the finished transfer case.
Exactly. But this is where that balance sheet comes in. Having nearly 300 crores in cash and virtually zero debt gives them an incredible superpower in this industry. Breathing room.
Because the automotive manufacturing industry is notoriously brutally cyclical.
Yes. When broader economic conditions weaken or interest rates rise, vehicle sales slump. When sales slump, OEMs aggressively cut production.
And for a highly levered supplier, a 6-month downturn in production can trigger a solvency crisis. They still have to service their huge debt while revenue plummets.
But for Divgi, they can comfortably weather that natural cyclicality without ever facing existential risk. They have built a financial shock absorber.
It allows them to absorb delayed OEM payments, sudden inventory buildups, or temporary production halts without ever needing to run to a bank to negotiate emergency credit lines at punitive rates.
Exactly.
So they clearly have the cash fortress to survive the present economic cyclicality. But what about the long-term future? We have to address the giant elephant in the room that every traditional automotive drivetrain supplier is currently staring down: electric vehicles. Let's look at how Divgi is navigating what might be the ultimate stress test for their entire business model.
The structural threat from electrification is very real, and it goes straight to the heart of their legacy expertise.
Because pure battery electric vehicles, or BEVs, fundamentally bypass the mechanical complexity of traditional internal combustion engine transfer cases and multi-speed manual transmissions.
Exactly. The physics of an electric motor are entirely different from a combustion engine. An electric motor delivers maximum torque instantly, from 0 RPM.
You don't need a complex manual gearbox with multiple gear ratios and synchronizers to keep the engine in a narrow, optimal power band. The motor just spins faster.
Right. And when it comes to all-wheel drive EVs, many manufacturers simply place a separate electric motor directly on the front axle and another on the rear axle.
Which completely eliminates the need for a traditional, heavy mechanical transfer case running down the center of the vehicle to split power from a single engine.
Exactly. The core mechanical products that built Divgi's financial fortress are at risk of long-term obsolescence in a world completely dominated by pure BEVs.
Consequently, their pivot strategy is critical for survival. They are actively utilizing their deep engineering expertise to develop dedicated EV transmission systems and high-precision reduction gears.
Right. They are attempting to capture new drivetrain content in electrified architectures.
It's a dual-natured reality for them. The EV transition compresses their legacy mechanical content, shrinking that historical TAM, but it concurrently creates new pools of content in e-axles and highly integrated electric drive units.
But looking at the operational notes, the utilization rate in their EV transmission business was cited at only around 25 to 30%.
That clearly points to a much slower than hoped volume ramp for these new technologies.
It does. Winning the early EV platforms during the development phase is one achievement. Getting those specific platforms to scale to high consumer volumes in the real world is an entirely different challenge.
Because the EV market in India is still finding its footing in terms of mass adoption.
Exactly.
I have to push back hard on this strategy, though.
Okay, let's hear it.
It sounds like they are attempting to fix an airplane while it is in a steep nosedive. If their legacy ICE products are eventually doomed to irrelevance and their shiny new EV utilization is hovering at a dismal 30%, isn't their EV pivot just a desperate, underfunded gamble?
That's a grim way to look at it, but go on.
I mean, they are going up against established global tech companies and Tier 1 giants who have been pouring billions of dollars into electrification R&D for over a decade. How does a mid-sized Indian supplier win that fight?
It is a highly valid challenge, but to understand their odds, you have to look closely at the realistic timeline and the specific architectural pathways of the Indian auto market.
Okay, what do you mean?
The EV transition in India is not an overnight flip of a switch. It is a highly phased, prolonged transition, heavily influenced by infrastructure constraints.
Right.
We are seeing strong, sustained growth in hybrid vehicle architectures and advanced ICE platforms that still deeply require mechanical torque management and complex drivetrains.
So the death of the internal combustion engine and the parts Divgi makes for it is greatly exaggerated, at least in the short to medium term within their primary market.
It is a race. It is a race between how long the legacy ICE cash cow lasts And given the realities of Indian infrastructure, that ICE runway is currently very long, versus how fast Divgi can get their newly developed EV components validated, integrated into winning OEM platforms, and scaled up to profitable volumes.
So they are effectively utilizing that fortress balance sheet generated by the IC era to methodically fund the intense R&D, the new tooling, and the capital expenditures required for the EV era.
For such
While that long-term existential EV battle plays out over the next 10 to 15 years, where is the growth coming from right now? If the domestic ICE market is mature, how do they expand?
They are executing on a few distinct, very deliberate growth levers. The first is premiumization within their existing footprint.
Right, they're intentionally moving away from supplying simple individual components and pushing OEMs to buy higher content, fully integrated modules.
Because when a supplier takes on the burden of engineering, assembling, and validating an entire system, the automaker pays a significant premium for that integrated solution.
Here's where it gets really interesting to me. The second major lever is export markets. This is a substantial diversification play that completely changes their total addressable market.
It really does. Management has clearly stated a medium-term target of generating 20% to 25% of their total revenue from international exports.
And in the first 9 months of FY26, they hit 17%, and the latest reports indicate that in Q2 of FY26, they actually crossed that 20% threshold.
Which is huge. They are actively and successfully expanding their footprint to supply Japanese, Korean, and American OEMs.
Which requires an entirely different level of capability. Winning a supply program for an export market is exceptionally difficult.
Incredibly difficult.
Yeah.
It means you have successfully navigated the rigorous, uncompromising quality audits, the exhaustive durability standards, and the stringent part traceability requirements of a global automaker.
It proves to the market that your engineering and manufacturing can compete on a world stage, not just within a localized, protected domestic environment.
Exactly.
The analogy that came to mind reading this is an actor graduating from a highly respected local theater production straight to Broadway.
That's a great way to put it.
Yeah, it is exponentially harder to get the parts. The audition process, or in this case, the global OEM qualification, is brutal and unforgiving. But once you survive that process, once you are on that stage and you have secured the part, the audience, meaning the market scale and the volume of vehicles produced globally, is astronomically larger than anything you could achieve domestically.
That is an excellent way to visualize the scale jump and to ensure they can actually deliver. When the curtain rises on this Broadway debut, they are executing significant capital equipment spending.
Right. They are actively building out state-of-the-art manufacturing capacity in anticipation of handling these massive new global demands.
But the research notes make a very critical point about their profitability. The quickest, most direct path to margin expansion isn't just bolting together new factory lines. It's driving better utilization of their existing manufacturing capacity.
Because this is the fundamental physical reality of their business model. Auto component manufacturing carries immense fixed costs.
Yes. You have to account for plant depreciation, multi-million-dollar CNC machines, expensive custom tooling, and maintaining teams of highly specialized engineers.
And when factory utilization drops, when the machines are sitting idle for half the day, those fixed costs violently crush your profit margins because you are still paying for the building and the equipment.
But as export volumes ramp up, and as they secure orders for premium modules, they push significantly more physical units through that exact same factory.
The fixed costs remain static, but the revenue increases. That incremental revenue flows much more cleanly, straight down to the bottom line, driving up profitability margins rapidly, without the immediate need to build entirely new factories.
Exactly.
Growth in heavy industry is rarely a straight line, though. And looking at the recent history, they have definitely hit some deep potholes. Let's examine the recent bumps they've navigated and the core risks constantly staring them down.
Well, they recently endured a severe cyclical reset. The fiscal years FY24 and FY25 were undeniably tough periods for the company.
Just to anchor us with the specific numbers from the reports. In FY25, their revenue dropped sharply to around 219 crores, and correspondingly, their EBITDA margins plunged to an uncomfortable 16.65%.
That severe margin contraction is the exact phenomenon we were just dissecting. It wasn't caused by a structural failure of their technology, nor were they suddenly losing market share to inferior products.
It was purely a symptom of poor fixed cost absorption, driven by unexpectedly weaker vehicle volumes from their primary OEMs.
Yes. The assembly line slowed down, the factory utilization dropped, and the margins collapsed under the weight of the fixed overhead.
But the rebound was equally sharp and illuminating. In FY26, we witnessed a dramatic turnaround. Standalone revenues surged to roughly 353 cores. That is a staggering 61% year-over-year increase.
And Pate, their profit after tax, hit 47 crores, representing a 92% jump.
And those margins, they recovered rapidly, bouncing right back into the healthy mid-20s percentage range.
This raises an important question about how observers and analysts evaluate heavy industrial suppliers. This recent earnings roller coaster perfectly demonstrates the leverage inherent in their business model.
Right. When OEM assembly lines slow down, high fixed costs mean margins get hammered instantly.
But the very second those OEM assembly lines start humming again, profitability rockets upward because the manufacturing capacity is already sitting there, fully paid for, waiting to be utilized.
And for you listening, when you are analyzing a business rooted in physical manufacturing like this, you have to train yourself to look past the terror of a single bad quarter.
You really do.
You have to ask the deeper, more structural question. Is the underlying consumer demand fundamentally broken? Or is it merely delayed by macroeconomic factors?
In Divgi's case, the Indian consumer's desire for SUVs wasn't over. It was simply a cyclical lull in production.
However, acknowledging that rebound does not erase the risks are ever present.
Definitely. The core vulnerabilities to monitor going forward begin with extreme customer concentration. They are highly dependent on a very select few automotive giants.
Right. If they were to lose a major platform contract on a highly popular Mahindra or Tata SUV, the financial impact would be immediate and severe.
Additionally, there's constant pricing pressure, particularly the looming threat of Chinese or other global entrants attempting to aggressively push into the localized Indian market.
And finally, you have input cost volatility. Sudden swings in global steel prices or spikes in the cost of precision machining tools and electricity can rapidly eat into their margins long before they are contractually able to pass those increased costs onto the powerful automakers.
Exactly.
Ultimately, steering a highly complex manufacturing company through those intense cycles, managing the unforgiving fixed costs, surviving brutal negotiations with monolithic OEMs, and simultaneously funding an existential EV pivot comes down to the people sitting at the wheel. Let's look at the management team and how the broader market views their strategy.
The company is deeply rooted in its engineering origins, led by its founders, Jitendra Bhaskar Divgi, who serves as the managing director, and Harendra Bhaskar Divgi.
Crucially, they are both highly trained mechanical engineers with over 30 years of hands-on experience specifically in automotive drivetrain products.
Right, so they aren't just financial managers parachuted in to optimize a spreadsheet. They are deeply experienced operators who intimately understand the physics of the metal they are machining.
Yes, and their track record regarding capital allocation reflects that deeply operational mindset. It is highly conservative and focused on the core business. They consistently reinvest their operating cash flows into organic capital expenditures, building physical capacity, upgrading machinery, and expanding engineering capability. You do not see them chasing wild, unrelated M&A deals outside their circle of competence, nor do they engage in complex, risky financial engineering to artificially boost short-term metrics.
Which is perfectly reflected in that pristine, essentially zero-debt balance sheet we spent time on earlier.
But looking at the current market sentiment, a fascinating dynamic emerges. The market isn't pricing them as a slow-moving, purely cyclical, traditional auto supplier tied to an aging technology.
Not at all. The valuation multiple suggests they are priced as a high expectations growth story.
Analyst sentiment across the board is quite positive, though several valuation screens openly flag the stock as currently expensive based on the sheer magnitude of the growth assumptions baked into the price.
The market is clearly looking past the legacy ICE risks and aggressively pricing in the successful execution of those growth levels we discussed.
Right. The powerful localization tailwinds driven by government policy, the successful scale-up of their high-margin export strategy, and the anticipated margin expansion resulting from better factory utilization.
It's a lot of expectation, but they have a path.
I do have to ask, though. It is a founder-led company that usually guarantees incredible passion, deep domain expertise, and long-term thinking. But does it also introduce a dangerous level of keyman risk?
It's a very valid concern.
Are the Divgi brothers successfully building a resilient, multi-generational corporate institution, Or is this ultimately just a very successful, highly engineered family shop that might struggle to operate without them?
It is a critical area to evaluate when looking at corporate governance. On paper, the board structure appears solid and modern. They have an independent chairman and a roster of independent directors, which theoretically provides the necessary oversight.
Okay, that's good.
However, their track record as a listed public company subject to quarter-by-quarter scrutiny is still relatively short. More importantly, the depth and strength of the management bench, the vital layer of executive leadership directly below the founders, remains an open question.
The research explicitly notes that the average tenure for non-founder senior management is relatively low, hovering around 1.8 years.
Yeah. As they attempt to scale into highly competitive global export markets and navigate the extreme complexities of EV systems integration, watching closely how they recruit, retain, and empower that secondary layer of leadership will be essential to determining if they can truly build a lasting institution.
Okay, we have covered a tremendous amount of ground today, moving from the physics of gear shifts to the intricacies of global automotive supply chains. Let's pull all these threads together.
Sounds good.
We have deeply explored Divgi,
Yeah.
a highly specialized, incredibly cash-rich Indian manufacturer sitting at the nexus of several industrial megatrends. They are successfully and profitably riding the structural wave of domestic SUV demand.
Right. They are fiercely defending their home turf against huge, well-funded global giants by utilizing a localized cost structure and deep engineering embedding.
And they are actively, methodically fighting to secure their long-term place in an electrified future using the cash generated from their legacy products.
It serves as a perfect, tangible case study of the complex industrial realities operating behind the scenes of the broader automotive sector.
Exactly. For you listening, we hope this deep dive illuminates a crucial reality. Underneath the shiny consumer brands, the huge dashboard touchscreens, and the glossy marketing campaigns of the modern auto industry, the real gritty economic battle is being fought deep in the supply chain.
It is fought in factories in Pune over specialized, heavily engineered metal, proprietary code, and fractions of a millimeter in machining precision.
And as the broader world and the financial markets become increasingly obsessed with software-defined vehicles, autonomous driving algorithms, and artificial intelligence, we might be severely underestimating the sheer immutable physical challenge of moving raw rotational torque from a motor to a rubber wheel contacting the road.
In a fully electrified, relentlessly software-defined future, will companies like Divgi, rooted in heavy metal, slowly become obsolete? Or will their deep, gritty, uncompromising expertise in physical manufacturing, their ability to actually make things that survive the real world, become the rarest, most valuable commodity in an economy entirely obsessed with software?
That is the ultimate unanswered question for the next decade of mobility and manufacturing. Thank you for joining us on this deep dive. Keep looking beneath the surface, and we'll catch you on the next one.